join as we get going. Before we get going, I would like to just do a land acknowledgement, which we always try to do at our CEBE events. I'd like to acknowledge that we're here today on land once nurtured by the Wabanaki people. Right here in Norway, specifically the Arasaguntakuk, who for millennia have lived in cooperation with this now shattered ecosystem, who are still fighting for their sovereignty, and to whom we all owe an unfathomable debt. So greetings, everybody. Looks like we're starting to slow down here. I'd like to welcome everybody to CEBE's first ever Impact Investing webinar. CEBE stands for the Center for an Ecology-Based Economy. It seems like some of you are new to our organization, some are not. My name is Scott Vlan. I'm the executive director here at CEBE, and I'm joined tonight by Renee Igo. She's our communications person who's doing the back of the wizardry behind the Zoom thing here. We also have Seal Rossignol with us, who's our education coordinator. I think she's gonna say hi. There you go. Hi, Seal. Seal. This was actually Seal's idea. And we're just delighted tonight to have Julie McVeigh from Fresh Pond Capital here, and Eric Becker, who's the Chief Investment Officer at Clean Yield Asset Management, and Ben Willauer, who's an independent consultant to investment impact investors. So some of you probably don't know too much about CEBE. We are a small nonprofit out here in Norway, Maine. We like to call it a social profit organization. We've been here about 7.5 years now, working on various community resilience projects out here in the hills of Western Maine. We work across interconnected areas of food, shelter, energy, transport, and most recently kind of doing a lot of education work with our local school system and other educational programming. We also are involved in some statewide coalitions, including Maine Climate Action Now. Maine Climate Action Now is a group of 5 different organizations, and it's kind of led by Maine Youth for Climate Justice. And so it's sort of like a youth-led organization with lots of adult allies, and we're pushing hard for bold and equitable, just climate action. We've been involved with the Maine Climate Council, their work, and we're also part of Climate Maine, which is a much larger coalition of different environmental organizations working to push the Maine Climate Council towards more bold action. I encourage everybody to check out MCAN's Vote Climate Justice campaign, which we're just launching now. You can link to it through CEBE's website. We're pretty excited about that. So CEBE kind of takes this whole systems approach, has led us to a lot of different projects out here in the community, from community food forest, edible Main Street. We've had a community bike share program here. We have done work with window dressers to build window inserts to make housing more efficiency and more energy efficient. One of our big projects out here is the Western Maine EV charging network. We've got 15 EV chargers that we've installed, so we've been kind of on this rural electrification of transportation thing for a long time. So we've got this whole network of chargers, and it's really led to quite a burgeoning EV community out here. Some of those chargers are on solar power. So trying to make that connection between clean energy and electric transportation. We have been working on community solar projects as well. And this is one of the projects where we started to realize that we didn't know enough about investing, about impact investing to get the kind of investment we needed in that. Of course, that whole landscape has changed dramatically these days. And most recently, we're launching our first enterprise, which is called Spoke Folks. It's a bicycle-powered trash recycling and compost hauling service. We launched it actually early this year because we launched it as a delivery service to deliver emergency food relief for the local food pantries. And in October, we're shifting to our initial business model, which is to haul trash and recycling in the community. So over the last 7 years or so, we have had so many events here. This is a community space around Main Street here in Norway. We've had over 100 events here. And then right before the whole world changed, we had a huge event here. We had Bill McKibben come to Norway and speak to over 300 people at our local high school. And then that was followed up by 2 days of movement building climate action workshops. We also work in direct action. I just see Roberta Hill came on. She's a kind of our climate action coordinator. We work with Citizens Climate Lobby and other direct action stuff. So in our event, in our 2020 Vision Climate Convergence we had here in March, we had a divestment webinar, I'm sorry, not a webinar. We had a divestment workshop when we could still do that. We had about 20 people in this room, and we were talking about divestment. And the obvious question was, so now that we're sucking millions and billions of dollars out of the extractive industries, mainly the fossil fuel industry, and trying to divest and push others to divest from fossil fuels, it's like, so what's next? So this workshop, this impact investing workshop, is really a response to that question. So what's next, and how do we bring together the investment that's going to be needed for this massive transition towards a ecology-based economy over the next 10 years to meet Maine's emissions goals and meet the goals of the country and the planet. Our tagline for CEBE is resilient communities restoring the earth, and so we got to figure out how to make this all happen, and we have to figure out how to do it fast. So with no further ado, I'd first like to introduce Julie McVeigh. She's going to lead us off with kind of more of a general approach, and then we're going to move into Eric and then on to Ben. There'll be a little bit of time for questions after each presenter, and you feel free to put questions in the chat, and Renee's going to keep track of those, and then we'll ask questions, a few questions of each presenter after their presentation, and then we should have plenty of time at the end for a deeper discussion. We can open it up so people can ask questions at that point. Sound good? Take it away, Julie.
Thanks, Scott. Terrific. So I'm going to give a little bit of an overlay of investing with a justice lens and values-based investing. I think of the broad scale of thinking of moving your money out of fossil fuels and into solar sounds great. And what does that actually look like, and what are the logistics involved in it? Thinking about the starting place for many of us is the question of why do it, and why be interested in values-based investing. In general, this is preaching to the choir because you're on the call and you're interested in this, but many of us are not the only decision maker at the table. You may have a spouse, or you may have parents, or maybe a trustee that needs some kind of like, why do this? And the response or critique I used to hear, and I'm hearing much less, is there was a criticism of, oh, I'll just make more money, however I'll make it, where the bottom line matters, and I'll care less about how I do it, and then I've got more to give to charity. And I think we are moving past that into really recognizing that the means matters, and how you invest absolutely matters, because you're creating the world that we're living in. We ultimately think about investing and investing money as a transfer of energy. Money is energy, and it gains its meaning in its movement. So when you think about your choices with money, whether you're thinking about saving it, whether you're thinking about investing it, giving it, spending it, it's really recognizing and saying, okay, each of these, what's my opportunity for impact here? And I think of the Buy Local campaign as doing a lot for just raising our awareness, particularly in this moment of COVID and quarantine, where we're all seeing shuttered businesses, and how do we support those, and how do we move away from an Amazon economy and really make sure that we're spending our dollars in local impactful ways. In terms of impact investing and values-based investing, as kind of their strategies. We consider there are 3 legs to the stool. And my colleagues on the panel will talk more about one of the legs, but it's important to understand kind of all 3 strategies and how they work in conjunction together. So one is the idea of screened investments. And these are public securities that are screened historically, we've talked about screening out investments like fossil fuels and screening in investments like renewable energy. The second leg of the stool is proxy voting. And proxy voting and shareholder rights and advocacy is really important in that this idea that when you're an investor in a public company, you have a say in how it's invested. And it's important to have that voice. And that voice really gets amplified as there's collective work. So there are listservs called Racial Justice Investing, Investor Advocates for Social Justice. They're organizing groups, they're organizing investors to create a collective voice. I think of tomorrow, there's a call organizing around Tesla and proposals that are going to be on Tesla's annual meeting. And what's important is not just saying, oh, Tesla's innovating a lot of good, interesting things around our environment, but what's the internal culture like? Is it a toxic place to work? Is it a safe place to work? How can we as investors bring forward that voice to look for the type of work environment as well as the products that we want? And then the third piece is this direct investment, and we call it community impact investment. And this is actually taking your money out of the markets and putting it and investing it. So it's not grant dollars, but actually investment dollars that are directly lent to projects that you care about or organizations that you care about. Examples, and I know my colleagues will talk more about this, but CDFIs, and CDFI stands for Community Development Financial Institutions. An example in Maine of Coastal Enterprise, CEI, is a great organization to know about, and one that allows investors to lend them dollars, and then they work connected with other organizations, making sure that they can then relend those dollars. So much of what we're talking about is this idea of the movement of money and paying attention to it, paying attention to ultimately building a portfolio that takes into account these 3 strategies. I was on a call earlier in the summer and sharing specifically about fossil fuel in free investing. And it's interesting because I think in 5 years, we may not be talking about fossil fuel free investing. I think in the way that social responsible investing really emerged in the 70s and 80s from anti-apartheid activism. And this idea of organizing collectively to divest from South Africa. And now we don't talk about anti-apartheid investing, now fossil fuel free investing. And yet, when we look at numbers, we see over the past 30 to 40 years, we've had 14 trillion assets move out of fossil investing. So you have this huge wave of movement of money away from fossil fuels. When we think about where we want to invest, investors care about investing in tomorrow. Meaning what's coming down, what hasn't happened yet, and what's going to be the way we run our communities that is innovative, that is sustainable. Fossil fuels really are the dinosaur that still have a little bit of presence here. And a few numbers, just that in the 1980s, the S&P 500, which is an index of 500 large US stocks, 30% of it represented fossil fuels. Now 2% of it. So you have it's just become a tiny piece of overall investing. You also have, it recently was announced, Exxon was kicked out of the S&P 500. So a lot of investors benchmark, meaning that they look to mimic and invest whatever the S&P 500. You're going to see essentially fossil fuels not be part of mainstream investing. So for those of you invested in mutual funds, it's much more likely that you may already be fossil fuel free and it's not even an activist fund. So know that kind of the movement of what's coming down the pike is really investing towards renewables. And so we're seeing that more. Let me just check in. The piece that I think we engage clients and just share with you all as you think about, okay, where does community investing fit within my portfolio? I always want to highlight recognizing what community investing is short on or what the drawbacks are. And the two that really stand out and come to mind is a loss of liquidity. Liquidity means you can't get your hands on that money. So if you need to pay your rent or keep your lights on, when you invest in community investing, it's not accessible immediately to you. So this should be longer term money that you don't need immediately. And the second is that the investments, and this is not exclusively, but predominantly, are not ones that have high financial returns. So the idea is that they have a good impact and they're doing something you want in the community, and they may not be returning to you more than 2%, 3%. And that's not true across the board. There are going to be examples where there are stronger financial returns. But it's important in terms of crafting a portfolio, recognizing that these investments in your portfolio may not keep pace with inflation. So if you're thinking, okay, I'm going to need my money back when I'm 65 and I'm going to retire, or I'm going to need it to buy this house, that it may have lost value next to inflation. And it's not a reason not to do it, but it's a reason to think about your portfolio as a whole. And when I describe thinking about your portfolio as a whole, really recognizing we engage some of our clients who are interested in doing a lot of community investing and less public markets, that when 30 to 40% of their overall portfolio is invested in public securities, and that can be a screen portfolio that are divested of stocks they don't want to invest in and invested for good, it is enough to power the entire portfolio against inflation. So this idea of diversification matters, this idea of balance of something called asset allocation matters. And just recognizing kind of to think about the whole. And I think the last piece, just there are different fossil fuel free funds. As you look for investing, my recommendation is to pay attention to investing with groups that are voting shareholder rights and active shareholder proxy work. And the reason I guide that is that those often are the ones really committed to this practice, much more than ones who are greenwashing and kind of advertising and saying, yes, we're doing this, we'll take out a few stocks. I think ultimately of this investment practice is one of community organizing, and it's movement-based. And the idea is that we're collectively acting instead of as individual investors, we're acting as a collective, and we're moving forward and proposing these values that we care about. So ultimately, I think of the nonprofits that we partner with, whether it's CEI up in Maine that we just think are doing great work there, or the Coalition to End Profiting Off of Our Prison System, that it's really important. It's not just about divesting from prisons, but really changing, I think of kind of the prison complex of how there's still a company store and prisoners have to buy from the company store, or telephone rates are just usury of how much they exploit prisoners and their families. Ultimately, our firm does have a mutual fund. The ticker is ESGEX, and we launched it last year specifically to do the investing that we have done all along. It only retails through Fidelity. So if you're interested, you can check it out there. The name of the fund is Reinders McVeigh Core Equity, and I can put that in the chat, but it's an easy ticker with ESGEX. That ESG stands for environmental social governance. So Scott, that is, should I open for questions or move on to?
Yeah, that was great, Julie. That was a really good opener. Thank you. Now I think we have 5 minutes to take a few questions. If people, it looks like a pretty manageable sized group. If people want to unmute themselves to ask a question, I see we do have one from David Gibson. If David, I don't know if you want to just ask it, or assuming you can unmute yourself. Maybe not.
Yeah. Hi, Scott. I was just wondering if there are opportunities for community-based investments that people can participate in. Like, I know I have an IRA and a 401k, and being able to use those investments that I do have, for benefit here in Maine for, these types of positive clean energy solutions.
Absolutely. And, I think the guidance that I give as a financial advisor is to pay attention to using your retirement funds in this investment where the risk parameters, the risk and return, there is a trade-off, meaning kind of the more risk you take, the more return. In an impact investing, that return may be impact. So it may be that you're taking more financial risk and getting more impact, but then you've compromised your retirement. So in general, in my practice, and I look forward to hearing Eric Becker's thoughts on this as well, I know Slow Money is a network of investors that individuals might like to follow. They've done a lot of good organizing work that are enabling investors to move all different types of money out of retirement funds or into different types of investments. Specifically, the two choices that I think are available is that we're seeing more electronically traded or electronically available CDFI investments. And what I mean by that is at Fidelity or at Schwab, you can buy and you can ask your investment advisor about Calvert. And Calvert isn't the Calvert mutual funds, but the Calvert impact funds. And Eric, you might need to update I know they recently changed their name. It was Impact Social. I think it's Calvert
Impact Capital. Calvert Impact Capital, I think.
Calvert Impact Capital. There are Capital Impact Partners is an electronic available investment. Self-Help Credit Union is an electronic available. Then all of these are bonds. Self-Help, it's a CD. Self-Help, what you're doing, it's actually a CD credit union out of North Carolina that also reaches into California. And they are longtime economic justice leader and investor that you can check out their website. And what you're doing is buying a CD. And CDs in general, they pay very little, but it's electronically traded. So David, to your question, that your IRA can be at Fidelity and then figuring out, okay, can I buy one of these bonds? They're not always available, but ideally kind of Fidelity or Schwab can help you, that they're starting to see more of them. And I know there's a self-help subscription out right now. And subscription means that they're coming to market and they're selling $6 million of their CD and looking for investors to buy it.
Great. Well, if there are no other questions for Julie, we've got a couple minutes. We're a little bit ahead of schedule. We made this little poll. We'll just throw up there, I think. Okay, I'm going to launch the poll, and just to kind of get a sense of who's here, and it'll be useful for the rest of the presenters too to see who's here. So I'm going to launch this, and we'll just give it a minute for everybody to click through on what brings you here tonight. There we go. Never been on this side of one of these polls. It's kind of cool.
Scott, it doesn't allow you to select multiple options.
No, you just have to pick one, I guess. It's my first poll ever, David, so I'm pretty excited that it's working at all. Looks like we're almost there.
I would have answered 2 of the options, answers 2, if I could have selected more than one, because I'm here not only looking for what to do with my own money, but also I'm interested in working with our community foundation to set up a socially responsible investment program,
Nice.
which they do not yet have. And I don't have a clue about how to do that. And I'm looking, and neither do they. So this is why I'm here.
Great, thanks, Frankie. Well, I'm going to end the poll, and I guess you guys will all be able to see the results. So this is, people are here because they have investments and are concerned that they have social impact. So I guess that's not a surprise. Everybody see?
To Frankie's question, I am a big proponent of keep asking, because, and I think Eric made this point when we were just preparing and getting on the call, the landscape here is changing so much. And so, you know, the community foundation may say, gosh, we don't know where to start, or, okay, we're trying this, and keep after them, keep asking. It really makes a difference. I think of racial justice. We've been asking for years, saying, what's your racial justice lens that you're using? And in the beginning, there was a little bit of like, oh, we need a racial justice lens. Oh, what should we have? And we didn't necessarily know the answer, but the idea is keep asking and keep pushing to have that conversation and to have options. So for community investing, I think of if it's in Maine, a starting place is, have you talked to CEI? Do we have money invested there? What are the starting places? But the idea is, and I know my future panelists will have even more interesting, not more interesting, but additional options.
Thank you.
Yeah, thanks. All right, well, if there are no more questions for Julie, how about if we switch over to Eric? You want to share your screen, and or maybe not?
Yeah, let's see how this works.
All right, give it a go.
People see that? Oil age to the soil age?
Yep.
All right, great. So this has been a mantra of mine since I think 2007. I got turned on to the fact that we need to take the carbon out of the atmosphere and put it back in the soil where a lot of it started, because agriculture has been a big source of greenhouse gases in addition to burning fossil fuels. But I have been an active participant in the fossil fuel divestment movement for quite some time here in Vermont. So my talk is gonna cover some of the same ground as Julie did, and get into a little bit more specifics about some impact investment opportunities or what the landscape looks like. It's an area that has really blossomed in the past 15 or 20 years, from a handful of investment opportunities to an incredibly broad array of exciting and creative ways that people are channeling capital to the places where we need it to build a regenerative and just economy. And as Julie said, it's important to think about your whole portfolio in terms of managing risk, also managing return, as Julie said, because you have to think about what your objectives are in setting out to do impact investing. So here's some more specific data that Julie alluded to. So Bill McKibben wrote the article in Rolling Stone that really launched the fossil fuel divestment campaign in July of 2012. And that built on the work of students at Swarthmore College who were calling for divestment of the endowment there, and others I'm sure were already on board with divesting fossil fuels, but Bill really drew attention to it and started building a broader campaign. And this chart shows the S&P 500, which is the white line, and the S&P energy sector, which is essentially the big oil and gas companies. And you can see for the first 2 years, from the summer of 2012 to the summer of 2014, the two lines are pretty much right on top of each other. And then they have gone their separate ways, and such that the S&P 500 has returned 150% since July 2012, and the S&P energy sector is down 50%. So you'd end up with, if you start with $100, you end up with $250 in the broad index and only $50 if you were just invested in that energy sector. And there are a lot of reasons for that. It's not because of the divestment movement, but the divestment movement did play a role, I think, in waking up Wall Street that the end of the oil age was fast approaching. And because of that, as Julie said, investors care about the future, and the future for fossil fuel companies looks bleak. And you can see just in the gray shaded area on the right, that's the current recession that we're in, or depression, depending on who you ask. And you can see that the stock market as a whole rebounded sharply after the March lows, whereas fossil fuels bounced a bit, but then rolled right back over. And there are real questions about the viability of the industry for the long term. So in some ways, divestment is the easy part, because there's been a proliferation of fossil fuel-free investment vehicles, as Julie said, many of them from mainstream Wall Street firms. Everybody now has a fossil fuel-free index. Not everybody, but there are a lot of them out there. But those funds do lack other social and environmental criteria that I think probably most of the people on this call would want to see in their portfolios. So as Julie said, keep your eye on the ball as you look for, for the funds that you're thinking of moving out of funds that are in fossil fuels into other funds. Make sure that they meet your values. But I think you're on this call because you want to do more than avoid the bad guys. You want to actually see real impact from your money. And that's where impact investments come in. And there is really a broad spectrum of investment opportunities, from quite low risk ones like community development loan funds or CDFIs, and credit unions as well. There are community development credit unions where you can make deposits. And I've listed a few here. In addition to CEI, Genesis Fund is another one in Maine. The Cooperative Fund of New England, which focuses on lending to cooperatives. They do a lot of work with food co-ops, but other types of cooperatives as well. And New Hampshire and Vermont also have strong community loan funds that do really important work making capital accessible to entrepreneurs and individuals who otherwise have difficulty accessing it at affordable rates, to build the kinds of businesses and communities that we all value. So that's really the best starting point for most individual investors in terms of step one of reallocating some of your portfolio into funds that are really making a positive difference. There are other higher risk opportunities. And as Julie said, risk and return are related to each other, and often our clients are willing to give up some financial return to get social or environmental return in its place. But there are higher risk opportunities, such as funds that focus on either issuing debt or buying, debt or equity in companies. A couple examples in our region are Fresh Source Capital, which is focused on food system investing, and the Vermont Sustainable Jobs Fund Flexible Capital Fund, which focuses on food, agriculture, and renewable energy. Neither of those are open to new investors, but these types of funds emerge from time to time and are great vehicles, mainly for high net worth individuals who are able to, due to the regulations, invest in these, because I will get to this in a minute, but there are regulations that make it somewhat challenging for Main Street investors as opposed to high net worth to participate in some of these. And then there are the highest risk opportunities, which are direct investments in individual private companies. And you'll find those in Maine. One way to access those is through Slow Money Maine. If you aren't familiar with their work, it's really one of the most robust slow money networks in the country, focused on connecting investors and entrepreneurs in the food and agriculture space. And they, out of that network, grew a investment club called No Small Potatoes, which pools funds among about 20 different investors and then lends it out in small loans to businesses, food businesses in Maine. So those are, when you're investing in an individual company, the likelihood of things going sideways or a failure are much higher than if you're investing in a fund, and therefore the risk is higher. The reward may be much higher too. The satisfaction in investing in a company and watching it thrive and bring a key service or product to the food system or the economic system can be really, really rewarding. This photograph is from a goat dairy in Randolph, Vermont, which we had some clients invest in, and its goal was to show that a commercial sized goat dairy in Vermont was a viable business for cow dairy farmers to convert to, because it's been the devastation among cow dairies has been so dramatic across New England, and the value provided by goats and the ease with which they can be managed make it a pretty attractive option. And recently we saw success in a major dairy operator selling all their cows and switching over to goats. And so that's a pretty satisfying story for us to have invested in a dairy that showed that it could be done, and then seeing that really take hold. So this is a little redundant, so I won't dwell on it too long, but as Julie said, it's really important to think about what you need your money to do for you before you take the step of starting to put it into some of these vehicles. You need to think about how much you need it to grow, how much you can afford to lose if an investment fails. Can I tie up money for an extended period of time, or do I need access to it? So those are, and thinking about like what percentage of my overall can I put an impact. So I just threw up a pie chart of a sample idea of maybe one client, which has a little over half of their portfolio in stocks, some in bonds, some in cash, and then a little wedge in impact investments. We have clients who do up to 50% in impact investing. Those are sort of outliers for most of our folks. It's between 5 and 15%. One thing of note, though, is right now we're in this strange environment where the interest rate you get at the bank or in a money market fund in the conventional market is essentially zero. So historically, community loan funds yielded less than what you would get at the bank or in a money market fund or in a bond. Right now, they yield far more. because if you can get 1.5 or 2%, you can get those kinds of rates of 2.5% on some of these investments, whereas right now conventional investments are approaching zero. So it actually makes it even more attractive because you're giving up less financial return. So the world of impact investments is really, to me, really inspiring because you have essentially social entrepreneurs developing investment vehicles to serve all these different spaces that are critical to building that just and regenerative world we're seeking. There are funds that focus on regenerative agriculture, social and racial justice. There's a great new fund in Boston. Unfortunately, it's not taking investor dollars right now because they raised too much, called the Boston Impact Initiative, focused on the differential between, or the barriers to entrepreneurs of color who don't have, because of the difference in household wealth between the average Boston white family who has a net worth of about $250,000 and the average Black family, which has a net worth of $8. This is a study from, I believe, 2017. It's one of the most dramatic disparities in the country. And when you come from a family that has zero net worth, it makes it that much harder to start a business. So Boston Impact Initiative is focused on providing capital to entrepreneurs of color to give them a leg up in getting their businesses going. So that's pretty exciting. Childcare, clean energy, urban economic development, rural, gender, public health, and then there are geographic focus. So you can, as you've seen with Vermont, New Hampshire Community Loan Fund, CEI, they all have regional focus. And then there are ones that are focused overseas as well. There's a whole lot of activity. If your interest is in serving the needs of people overseas, that's something where there's a lot of offerings. I mentioned barriers. Many of these opportunities, you need to be an accredited investor, which means you need either $1 million in assets or you need to earn $200,000 a year or $300,000 as a couple to qualify for them. So that kind of boots a lot of people out, unfortunately. But that is intended to protect people from being investing in things that are really not suitable for them, where they could lose money that they really can't afford to lose. And also private companies are limited in their ability to reach out to new investors. So the other big barrier is that it just takes more time and energy to research these things. It's really easy to find out about mutual funds or Apple stock, but there's more to it to do this. So you need to be willing to put in a little bit of time, but don't let that stop you. It's totally worth it. So here are some resources that I think can be useful. Happy to share this slide with folks. The Opportunity Finance Network is really the coalition of CDFIs. They have a locator. The map on this slide shows in New England, the CDFIs that they've located in their database. So you can find things of interest there. The US SIF, which stands for the US Social Investment Forum, has a new free online course about sustainable investing, which includes an impact investing module. So if you follow that link, the courses link there, I haven't actually done it, but it looks promising. So check that out. Slow Money Main's great for networking. Green Money Journal is a broad social investing, sustainable investing electronic newsletter, which I highly recommend. So think about what you want to grow, and hopefully you can find opportunities to do that where you are.
Thanks so much, Eric. I love your last slide here. Reminds me of spring. There were a couple of questions, something going on in the chat here. Frankie had a question again around if you set up a new fund, does it have to have an exclusive focus, or can you combine several social responsible focuses or foci in one fund?
So I will interpret that to mean as in a portfolio. I think that's what the question is, unless you're actually talking about starting a fund for other people to invest in. But certainly within your own, whether it's an IRA or just taxable investment account, you can invest in multiple opportunities. And I would just add to the question about IRAs and 401ks. 401ks are more restrictive because there's a 401k administrator who chooses what your menu of options are to invest in. IRAs have a lot of flexibility, and in fact, you can invest in practically anything in an IRA. And there are actually the challenge can be where it will be custodied, because these things need to sit somewhere. And so there are custodians who focus on what's called self-directed IRAs that allow investors to open an account, invest in some of these, a private company or a community loan fund, and have them hold it. So it's an added level of administrative burden, but it's totally doable. So Millennium Trust is the custodian that we use. And there are costs to doing that as well. So, but it's worth looking into.
Awesome. Any other questions from participants? Well, thanks, Eric. That was great. I love the way this is going. Ben, I guess you're up.
Okay. Hello, everyone. I'm going to work on sharing my screen. I'm pretty sure Millennium Trust is in the Midwest. Am I right? Are they in?
Yeah, I think they're Chicago or.
Chicago.
Yeah.
Can you see my screen?
Looks good.
Okay. Hi, folks. Thanks for sticking with us. Greetings. My name is Ben Willauer. I'm here in Eustis, Maine, up on a ridge. And I'm going to talk about a little bit of some of the trends that we're seeing, at least here in New England and broadly. And by way of introduction, I was a financial advisor for just under 10 years. And I left that industry when I found myself a little dismayed at the lack of offerings, especially for larger investors who really were looking for a little bit more of a fully rounded portfolio. And when you really, as a manager, looked out for offerings that their clients were asking for, there were really limited chances. So we launched a fund focused on corporate governance reform, where we were investing in good governance companies, which were often family businesses, and we were actually shorting or celebrating the demise of some of the worst companies in America, like those private prison companies and others. Our short portfolio actually did very well in that time. I moved on to incubating some aquaculture ventures. Aquaculture is a very interesting space right now, and that is something that we're very focused on in Maine, because we're one of the largest aquaculture states in the United States. In terms of my work now, I'll get to that in the slides, but it's a really exciting time. So this is, you've divested, you're thinking about what to do next, and let's just go through a couple of the basic steps. Step one, and I'm just speaking as a past financial advisor. The two you've just heard from are amazing, and I would just emphasize, you really, if you feel your financial advisor is talking down to you or not listening to you, or just sort of nodding their head like, yep, you want to do this, but doesn't really represent that in their business, you really should shop around. There are plenty of excellent advisors that are really highly educated in environmental, social, and governance issues, and really are keen on Juliet brought up a term called greenwashing earlier. Greenwashing is when you look at your portfolio and you see that you have renewable energy in your portfolio, and you feel great about that. And then you realize that that renewable energy might be a series of dams in Maine that are destroying a watershed. And in fact, the community's in an uproar around that, and or some other local issue. And although you're thrilled about the idea of renewable energy, the folks that put together that offering didn't really care other than we want dams in a portfolio. And unfortunately, the folks that are involved with some of these, constructing these offerings really don't think holistically the way maybe we would. So greenwashing is something to pay attention to, and one that is actually changing pretty rapidly. It was pretty prevalent even 5 years ago. I would also emphasize, if you're not somebody who's sitting there with millions of dollars, but you are a constituent of a community, a member of a family office, or somebody who was active within, let's say, a university, or even within your public pension, you have a voice, and you've heard a lot of people talking about divestment. Once I was at a conference, and as Mayor de Blasio was running for office and championing his position on divestment of guns, the controller said to me, well, we don't believe our indexed portfolio really counts in that statement. So we've just seen politicization of these divestment claims where the underlying corpus of the assets was still fully exposed to guns. And that was just, in my opinion, pretty terrible. And you really should always, if you're fired up about that topic, don't just take somebody's word for it. Ask them to demonstrate that. You can also support organizations, either financially, socially, or politically, such as CEBE, and there's a zillion others out there, and you can support them with your effort and/or with your capital and/or with other people's capital if you can convince them to join you. But really speak up about these topics. And one of the, I mean, I can't emphasize, I was knee deep in this topic when McKibben's article came out, and I at first took a bit of issue with it because of the fact that at the time, all financial advisors were really looking towards indexing with their clients to reduce fees and getting away from active mutual fund managers who had much higher fees. And fees are a very important aspect of your portfolio management. But indexing really doesn't pick one particular sector of the economy versus others. And Bill's article really challenged that in a meaningful way and a very effective way. But it was a very bottom-up driven event. And I can't emphasize enough that continually pressuring the financial services industry to respond and give further offerings to more sustainable, holistic, local, and really understanding where your money is going is very, very helpful in an age of indexing where your money can be very highly diluted and you're really not particularly sure where your allocation is. Okay, next up, walk the talk and talk the walk. So, you know, I personally look at a portfolio, and rather than think about impact investing as a slice of the pie, I just sort of think of it as a lens at which I look at all of the investments. And sometimes there are particular investment spaces where it's tough to find a particular fund or offering that makes sense for you, but you still need to diversify. That's fine. We can do what we can do. But I think one of the most rewarding things that's happened lately is Yale, and then later Larry Fink, these are people, Yale has one of the largest endowments in the world, and Larry Fink is one of the largest, is a head of the largest asset manager in the world at BlackRock, started writing letters to all of the companies they were investing in and saying, we expect you to think of this not as a polarizing issue, like do you believe in climate change or not, really focusing more on risk mitigation and understanding that there was some embedded systemic risk within a given business plan. So if you were financing a power plant, there was often assumptions made within those offerings that were basically not taking into account climate risk. And so often, if you were putting up many, many millions of dollars, there was a whole lot of hidden facts behind the risk side of it. So if you're in an environment where you feel that the people you're talking to might be triggered by the topic of either climate or ESG or SRI or any kind of values-based investing, really, I would pivot the discussion more to risk mitigation and really understanding what you're investing in and how that governance and the overall controls are operated. There are many companies that you know of in the stock market today that really don't listen to their shareholders at all, and their board is fairly insulated, and their C-suite, the people who are in charge, really run the company as they see fit and can really stretch ethically to what they're doing. Facebook is a great example of that. So oftentimes you really have to think of things a little bit more holistically. Kids are really not taught about money, and it's really unfortunate that we don't have that as a core aspect of our U.S. public education. There's some folks that do a great job of it, but I would strongly encourage you within any families that you're involved with to encourage kids to get engaged, to share your any aspect of your banking or investment strategy with kids where you can, because it's just oftentimes when clients would come into any of our offices, their level of sophistication, wealth is not a corollary to intelligence, especially financial intelligence. And there are many people who either have gathered or inherited many millions of dollars or just some money, and they've never really understood even the difference between a bond or a stock. And that's completely understandable, but it's something that you very much want to tackle early with your kids. And then lastly, there's just some really good podcasts that have emerged over recently, as well as many other print publications. So there's a ton of information on what's going on within impact investing. And I would strongly encourage you to look at that, because there are things that are happening regionally in, I don't know, some parts of the Northwest with like fisheries management that suddenly have a lot to do with what's going on in the Northeast. So something that there's a lot of information out there. So some trends that we've seen locally, and when I say locally, I'm in Maine, and this is sort of in New England. So we had a new state government come in and create some incentives for community solar farms to be created, and created a couple of key aspects of the rules of those farms that decoupled the actual real estate from the actual farm and the investor, which created a prolific incentive for solar developers to enter the state of Maine. So over the last 5 years, almost every transformer in Maine has been spoken for as it relates to a permitted solar project. And there's a bunch of that in the news. And it's a very exciting time to see such a rapid deployment in a state that was very, very slow on the uptake with solar. Forest carbon offsets are interesting. If you happen to know anyone or be part of an organization that has even as more than, let's say more than 10,000 acres of land, which is not that many people, but some conservation organizations and First Nations have large holdings. And if you were to pledge those holdings to the California Air Resources Board for 100 years and have a very quantifiable measurement regime in terms of the growth that occurs, even if you're cutting wood for pulp and paper, but if you're allowing additional growth to occur and carbon sequestration to occur, the revenues from that can be in the many millions of dollars, depending on the size of the land that you're pledging to that market. And that is not, to be clear, that is not a pay to pollute scenario, as many love to articulate, because it's alliteration or whatnot, but it's very much California is very strongly incentivizing industrial polluters to change their behavior through other regulatory means. This is a very small way for them to buy down some of that obligation, yet it provides a huge amount of money for folks that may be land rich and cash poor to reinvent their economy. This is especially relevant here in Western Maine, as well as in other parts of the Maine that have seen a lot of volatility within the pulp and paper industry in the last 5 or 10 years. We had a stretch there where 5 of our largest paper mills went under in a very short period of time, and was economically very devastating to that overall economy. We've seen land-based aquaculture. I had direct involvement with the outfit up in Bucksport. There's also a few others that are operating one down in Hartford. Ideal Fish is a really cool company. If you're ever around Hartford, you should check them out. And there's some others that are permitted, and there has been some controversy there, but most of that has to do with siting and community relations. You can pick a bad site for one of those. They're very large facilities, but they do represent a huge opportunity for very sustainable protein to be cultivated. And lastly, I mean, I'll just wrap up with aquaculture. I think it was yesterday at Maine Startup Insider's website. There's an outfit that is taking seaweed and is going to grow it at a large scale and drop it offshore to, again, do carbon sequestration. They've received venture investment from some of the larger investors in Silicon Valley. There's a lot of money in carbon sequestration. Maine is much a natural resources state, and we have the ability to do that. Again, this is capital that is going into impoverished communities in rural Maine that can really, really help. Redevelopment of stranded assets is what it is, and you'll see a lot more of that in areas where you have mature dams, power plants, or other large items that are strategically important for the grid or for infrastructure, but how they are operated is antiquated. The two projects that I'm directly involved with, very briefly, you won't see anything about the Indus Fund online now. We're going to go live in maybe the next month or so, but just working with a local, the goal here is to create a replicable model for if a group of folks want to get together with a interested local credit union and have the ability to raise some money. We structured this where we capped the investment at $21,000, so it was not for ultra wealthy folks. And it was focused on the immigrant population of Southern Maine or Maine, because we found that there was a real funding gap for folks who didn't have access to credit. We've seen a lot of interest in that as a structure, and we're trying to enable it so that if you're in Burlington or Portsmouth or in Hawaii, you can do it there too. The other outfit that I'm working with is Grow Oyster Reefs. This is, again, going back to that carbon sequestration and also coastal resiliency. With all things climate risk, we're seeing a huge need for innovation within how to create more resilient, or called natural climate solutions or resilient shorelines. And that is a woman-owned company that has got some very interesting innovation in how you can rapidly create a reef and also create more organic growth. So that's it for me. I'll take any questions you have, and these folks are part of, this was the earliest group of Tuck Business School students out of Dartmouth who came out to Hurricane Island. We created a thing called the Hurricane Island Foundation about 10 years ago that tries to teach kids how to create meaningful change on climate. It's one thing to know about climate change, it's another thing to get a whole community to follow you. And this was a group of business students that were highly interested in helping us build a defensible, profitable model on that. And I'm proud to say 10 years later, that organization is doing great work in the middle of Mid-Coast Maine on Hurricane Island. So that's it, and I'll take any questions you have.
Oh, thank you, Ben. That was great and really inspiring to see some, some real on-the-ground projects. There's a few things that are coming up in the chat here, I see. Becky Bardovic has kind of called you on that last slide about the kelp, kind of stacking functions with shoreline protection and carbon sequestration. Somebody had asked about, could you talk a little bit more about aquaculture as carbon sequestration? And maybe you were just talking specifically about the seaweed, kelp beds, seagrass and kelp. Yeah. But maybe more about the fish itself. I don't know.
Well, I mean, so it's a very interesting topic right now in the marine conservation space. So one hat I wear is that for the last 10 years, I've been a trustee of the Nature Conservancy in Maine, and for the last 3 years, I've been their treasurer as a volunteer. And so it's given me an opportunity to see some larger trends within a larger organization, and Maine happens to have one of the more robust chapters within the country. And you can sequester carbon. There's an really interesting program happening down in the Gulf of Mexico in the Yucatan, where they realized that there was an enormous amount of risk associated with the hotel industry for hurricanes, and they created an insurance product relative to reef restoration. And They being the Mexican hospitality industry and the Nature Conservancy and a few other local NGOs. And it was just innovative financial instrument that allowed the hotel industry to ensure the reef funding to be created for reef restoration, and sort of an NGO to help with the direct measurement. In terms of carbon sequestration, Running Tide, I believe, is the name of the company I just referenced there in Harpswell, Maine. That just hit the paper, I guess, in the last day or two. But they were focused on really growing oysters and looked at the seaweed cultivation that's been happening pretty regularly. There's been a lot of growers in Maine where there's been a lot of challenge has been in the actual the products that are being developed, and you don't see an oyster grower or a kelp grower driving around in a Lexus anytime soon. They're all working their tail off, and they're not making a whole lot of money, but everybody is passionate about that space. And carbon, from the point of view of institutional capital, carbon is a mispriced asset. So currently there is a lot of folks that are very interested in funding carbon sequestration, and as long as it can be clearly measured, as well as they are very interested in looking at carbon as an asset class that should we get into a larger regulatory regime with carbon, there could be a lot of value in finding areas in which to invest in that space. And that it's not my expertise, but there is, if you're a natural resources state and you can grow a good amount of organic material in a very healthy and robust, diverse Gulf of Maine, there is an opportunity to not just do lobster, to do a lot of other diverse things. Maine does have some coastal politics around that, around marine spatial planning, but good people are all working really hard on that.
Interesting. Thank you. Any other questions from anybody about that particular aspect of carbon sequestration? One of the things that CEBE does, we have a chapter of the Citizens Climate Lobby, which is a carbon fee and dividend project. So when you're talking about like people being able to invest in carbon sequestration, like where does would the profit or the return on investment come from regulation, such as a fee on carbon that would then be paid to all of these different groups?
Yes, that would be one model that has been demonstrated, but there are opportunities for other models to be developed. Ultimately, the folks who are funding this work now, she's one that's local to Maine partially. They say they're from Palo Alto, but one of their partners is in Maine, is Valo Ventures, V-A-L-O, I believe it is. Anyways, there's a lot of interest in, hey, we really need to create at the venture level or large NGO level a strong incentive for innovators and entrepreneurs to really look at that need for increased carbon sequestration. I mean, that's just a real critical need globally. So because of that, there is a lot of interest. In terms of profitability on the back end, absolutely, you can then create a structure where you are then funded through a regulatory regime around pricing carbon. And there are folks that look at carbon based on what is the California and or Quebec market doing, and then there's a voluntary market that is less, it's not as required, and then there's also folks that look at the price of carbon just on an ecological basis and having nothing to do with buying and selling, and that those numbers are widely divergent right now in terms of what the price should be. But again, it's a relatively early time for that. right now. It's just not a big liquid market. Another space is municipal finance. That's another really interesting space. Hurricane Irene came up the Connecticut River, and Dartmouth was studying the heck out of it. And some communities had floodplain mitigation and some didn't. And some of those that didn't had a pretty huge insurance claim, and others that had floodplain mitigation were fine. The farms flooded, and that was what was supposed to happen. And so municipal finance folks and bond banks are thinking creatively about, could we create a different source of capital through bonding that might allow states to invest more in resiliency than they currently think they can afford.
Cool. Becky Bardovic's raising her hand over there.
Hi. I was just going to actually throw it to David Gibson, because I wonder if any of you have, oops, my dog is talking to me. If any of you talked about the Green Bank. I was a little late because I got off the ferry, and so a little bit late. So the Green Bank was an idea that came before the Climate Council, and it seems like a really interesting idea to me, divesting funds out of the state employees in a retirement fund. But David Gibson knows a lot more about it, and maybe I don't know if this idea has circulated around at all with you, Ben, or with other folks.
So I guess I'll jump in for a minute. Thanks, Becky. Yeah, so the concept of a green bank is to utilize public funding to leverage private capital to invest in efficiency, clean energy, and other climate solutions. There's very successful green banks in Connecticut and New York, and infrastructure banks in New Jersey and Rhode Island, and about a dozen other states that have created green banks in the last 4 or 5 years. And I helped to pass legislation in Nevada when I was living out there to create a statewide clean energy fund. And I've been trying to get legislation passed in Maine, and it got handed over to the Climate Council. And it seems like every working group of the Climate Council has identified the need for additional funding. And so certainly there's a need for additional capital. And the idea that I have for financing the Green Bank, and I don't want the two to get conflated because this gets very political very quickly, is that the public employee retirement system in Maine had $1 billion invested in fossil fuels as of the end of last year. And as the graphs Julie showed indicated, those investments are now significantly smaller. But having several $100 million sitting in the public employee retirement system that is in terrible investments for those of us that thinks that fossil fuels have to go away, it just seems like there's a huge opportunity there to reinvest those into local solutions that create local jobs and can still have a return on investment for the retirement system.
David, on that point, it's interesting the timing that you may make now that kind of we're in quarantine and we have this unusual economic situation, that we may see an uptick in these stocks, these fossil fuel stocks, given that we're expecting some economic recovery. And as that recovery happens, there's going to be an increase in demand for oil in the short term. And when demand outpaces supply, you have a rise in prices. And so we expect it to be short term, meaning like long-term investing is what we were talking about, of trend investing and ultimately fossil fuels being dinosaurs. But it's an interesting moment that as you make a case for divestment, or for anyone here who's kind of making a case to say, hey, if there is an uptick in prices in fossil fuel stocks, sell high, let's get out now and not wait to see kind of last person standing.
Good point, Julie, because it seems that everybody's just kind of counting it down until this whole fossil fuel industry just kind of implodes upon itself once it reaches this tipping point. Been reading Jeremy Rifkin's latest book on the Green New Deal, and he's just predicting it happening at some point, and it just coming down like a house of cards with this notion of stranded assets, and just to try to hedge our bets as much as we can before then. I don't know if anybody...
It is happening right now, and it's mostly the U.S. fracking companies that are going out of business. And from what I've read, Russia and Saudi Arabia are going to do everything they can to keep prices low to gain market share. And at this point, they're trying to keep all the U.S. fracking from coming back online that requires, prices of $50 a barrel or higher to be profitable. And so there's a lot of consolidation that's happening within the oil industry, and a lot of bankruptcies that are happening right now. And I certainly don't expect ExxonMobil or BP to go out of business anytime soon. But BP has announced that they're moving into renewables in a big way, although they did a lot of greenwashing on that front probably a decade ago and made a lot of claims. So them saying they're putting $1 billion into wind is, I don't know what portion of their portfolio that is, but it still sounds like small potatoes to me.
Anybody
That's
else?
the great irony. If they hadn't been greenwashing, they actually would have been doing good investing. They would have been pivoting and sustainable.
David, I think you did a webinar on the Green Bank a few weeks ago. Is that right?
Yeah, it was in late June, so it was a couple months ago now.
Yeah, time flies. I would encourage people, if you haven't seen that, to look that up, because it's a really good overview of a really good idea. And politics happens when people call the representative and say, "I support that good idea." So I would recommend, if you think we could change the way we finance some of these newer projects. We have a very open administration in terms of listening, and they're using the Climate Council very effectively, in my opinion, to really vet good ideas versus pie in the sky stuff. And the Green Bank is one that makes a lot of sense, and it's already been proven in many other markets.
And while we're on the Climate Council and state politics, there's a lot of talk about the consumer-owned utility, or switching from an investor-owned utility, and just in terms of the, I guess CMP is guaranteed a 12.5% cut off of the ratepayers to, for their investors, and there's a push to invest in consumer-owned utilities that would be bond funded at a 3% rate. Does you guys have any thoughts about how that might play out, and how that transition might happen?
I can just briefly say that it's very complicated. We are part of a large grid that spans to New York from Maine through ISO New England. And we have multiple foreign-owned entities, multinational corporations that have utilities in Maine and other parts. And personally, I think it would be great for stakeholders to control their own outcome. It's just really difficult when folks in another country are deciding the future of your landscape, or how your natural resources are managed. It's just not, generally people take care of their place. And so I would very much encourage you to support those ideas, but at the same time, there's just there are a lot of lawyers in the room on that one.
Mm-hmm. I mean, we're seeing it directly affecting us here. We have a community solar farm that we've got the town of Norway to actually give us a site for free. It's a sealed landfill. We've been in the CMP queue now for a year, and we still can't get the project off the ground because they have no interest in building out the infrastructure to support more distributed local generation. So it's
Needs to be in the news more. That really needs to be in the news more, Scott. I just want to say, yeah, that's so incredible.
we'll keep working on that. Well, if nobody has anything else about this, like global political fossil fuel pending crash, I'd like to just turn it completely the other way. I think somebody mentioned the Cooperative Fund of New England. I think Eric did. So we're launching this little cargo bike service here in town. We're modeling it after the pedal people down in Northampton, who have like nearly $1 million cooperative now hauling on bicycles. So we're looking for, a loan from CFNE for, between $5,000 and $8,000. We're still kind of working out our little startup for a couple, another trailer and a bunch of bins and stuff. And I think Julie spoke a little bit about these smaller, like micro lending community funds. Like, what would that take to start a fund in our community? Like I know Bodenham did this. They had like a community fund that they could loan a farmer $2,000 or $3,000 for a tractor, that kind of stuff. And how does that work? How would we look at setting something like that up? Just throw it out there.
I can take it, or does anybody else want to?
No.
I've been talking a lot.
Ben, why don't you start?
Go for
and
it.
then I'll share.
Yeah, you guys can toss this
Okay.
one.
Simply put, you need a securities attorney, and you need to basically sit back and write. You basically have to organize what is the model of your overall fund in terms of what are you putting forward in terms of an investor policy statement, and what are you telling your investors that you're doing from a manager point of view. Typically, there are very affordable ways to create a fund, but unfortunately they restrict themselves from a compliance point of view and SEC regulations to accredited investors that we talked about earlier. If you want to create a fund that is open to individual or retail, we would call them investors, it can be you almost really want to partner with a fund manager that is already in existence, because they have the infrastructure set up to be able to support you there from a compliance monitoring and operation side of things. Anytime you are handling other people's money as an intermediary, it is pretty strictly regulated when it comes to non-accredited investors. And so it's very important to understand that is the line. So you just have to see what you're trying to do. If you feel that there are corpus of accredited investors that would support that fund, and there's an appetite for it, it is not that complicated to set up and execute that from a legal point of view.
I would just add that I mentioned the No Small Potatoes Investment Club. There is a safe harbor regulation that allows for individuals to get together and collectively decide how to invest money that's been pooled. It's a bit cumbersome, but it's quite democratic. So it depends on the scale you're talking about. I believe No Small Potatoes essentially had 20 people putting in $5,000 each and then making $5,000 loans out of that to small food enterprises. That's the basic model. Whether that's doable for what you're talking about in terms of lending to cooperatives in your region, maybe. So it would be worth talking to Lindsay Weld, who's one of the co-founders at Slow Money Maine of No Small Potatoes, to see exactly how that worked, what the barriers were, what went well, what didn't. I participated in we did a copycat fund when I lived in Boston called Sprout Lenders, based on the model that No Small Potatoes did, but we found that in the Boston market, such small loans weren't attractive to the entrepreneurs. And so we got a few loans out the door, but found that the amount of work it took to do that wasn't worth it for the participants. We had a great time and built some social capital, but in terms of actually catalyzing the flow of dollars into local businesses, it wasn't effective.
I also will add one other model, and both of Ben's and Eric's suggestions are spot on, is to look at what the CARET project has done. So the CARET project ultimately is a nonprofit where they're not a CDFI, so they haven't gone through that registration process. And I think of their model as one of shaming the banks into doing the lending they should be doing. And to paraphrase, and I think Eric's on the board and can talk in detail about their work, but is really this idea that our investors put their money collectively at a bank, a local bank, where really this lending should be happening, and they underwrite the lending directly. So they say, you know what, we will not use the bank's FDIC insured deposit. Our money is directly being lent to this cause, this cause, this cause. And ultimately the CARET project was the one brokering and negotiating that.
Great point, Julie. Thanks for bringing it up. And I'm no longer on the board, but I was one of the founding board members of the CARET project. And they have gotten to the point where they're actually really no longer a lending organization, because they have been effective at showing that these small to medium-sized loans to farmers, that's a viable business for other lenders. So now they're more in the technical assistance business to help farmers get ready to apply for those loans by making sure they have the business plans and all the legwork that you need to do to really be able to use capital, which is such a critical part of this whole process.
Oh, I love that notion of these kind of ragtag outfits leading the way, and then the banks kind of catching on. So we are pretty much out of time. Becky has her hand up. One last question.
One of the things that I've done as participating with So Money Maine is that using a local cap agency as a granting organization, so you don't even have to set up a nonprofit yourself as a, for grants, if you have people who are interested in granting to you to get something started, is one way that some projects have gotten going, including so down east in Eastport, there were a number of people who invested in Tide Mill Farm developing their chicken processing plant, and it was through the cap agency, donations to the cap agency, so the investors were getting a tax deductible donation. So anyway, one possibility.
Wow. Well, thank you guys so much. I feel like I'm seeing a vision for a different future of how capital flows through our system here. I think we could keep carrying on this conversation for a long time, but it is 8 o'clock and I want to respect everybody's time. So thank you again. And I would say drive safe, but we don't have to drive anymore. Except I do. All right. Good night, everybody.
Thank you.
Again, and we'll have a recording available through our website. And if anybody wants slide decks, we have those. So stay in touch with CEBE. Check out our website. Check out the Vote Climate Justice campaign. Let's be the change.
Thanks, everybody.
Night, you
Night.
guys.
Great.
All right, thanks.
Thank you very much.
Hi, everybody. Thank you.